Welcome to the Clean Slate Podcast, brought to you by CleaRank.com.
Great to be here.
So today we're talking about gold. It's been around forever, hasn't it? And seems like it's popping up in conversations again lately.
It definitely is. Prices have been, well, interesting. So yeah, lots of people are asking about it.
Right. And what we want to do today really is break down the safe ways you might consider adding it to your investments. We're pulling from the expertise we have right here at ClearRank, naturally.
Exactly. The key word there is safe. Because, with gold prices moving like they have, it's tempting to jump in, but you need a plan.
Yeah, you don't want to get caught up in the hype. So our goal is to give you, our listener, a really clear picture of how gold could fit into your financial strategy without making it overly complex.
Simple, actionable information. That's the aim.
Okay, so let's start with the basics. Why even think about gold in the first place?
Well, that's the fundamental question, isn't it?
Mm-hmm.
A lot of financial pros talk about gold as like a core part of a balanced portfolio, especially if you're looking for something a bit defensive.
Defensive. You mean like something to kind of cushion the blow if other things go down, like a financial shock absorber?
That's a good way to put it. Historically, gold has often been that go-to asset when, the economy gets a bit rough or when people start worrying about the value of, well, regular money, currencies.
Because it's tangible, something real you can theoretically hold.
Partly that, yes.
Yeah.
And it's not tied to any single government's decisions in the same way a currency is.
So if one country's economy hits a rough patch, gold doesn't automatically follow it down.
Generally, no. That's a big part of its appeal. Jacob Bakshi here at ClearRank actually put it really well. He calls gold the ultimate safe haven asset.
Safe haven, okay.
Yeah, especially during really big crises. Things like, wars, major financial scares, political instability, situations where trust in traditional systems gets shaky. Gold tends to hold its value globally in a way fiat currencies might not.
Got it. So it's kind of like the financial world's emergency backup plan, in a sense.
You could say that. It's seen as preserving wealth across borders and through turmoil.
Okay, that makes sense. But what actually makes the price go up or down? It's not like they just, trip over a giant gold mine every Tuesday.
No, not usually. It really boils down to the classic supply and demand.
Okay.
If there's a major new discovery, that could increase supply a bit, maybe ease prices. But more often you see shifts in demand. Central banks might decide to buy more gold for their reserves, or maybe lots of investors suddenly get nervous and want gold.
And that pushes the price up.
Exactly. Increased demand, same supply.
Yeah.
Price tends to rise.
Simple economics. Now, I've also heard it called an inflation hedge. What's that about?
Right, the inflation hedge idea. Basically, when the cost of things you buy every day goes up, that's inflation. The idea is that gold might hold its value better than cash.
So your money buys less bread, but maybe your gold still buys roughly the same amount of bread.
That's the theory. Investors turn to it to try and protect their purchasing power when currencies are losing value.
Okay, so when things get expensive, gold might look shinier.
It often does. But there's always a but in finance, isn't there?
Always.
Things like rising interest rates can make gold less attractive because gold doesn't pay you interest, right? So if you can get a good return from bonds, which are generally seen as safe, why hold gold?
Ah, the opportunity cost.
Precisely. And also, periods of economic stability or political calm can sometimes dampen the demand for gold, too. People feel less need for that safe haven.
So it's a bit of a balancing act. Inflation pushes one way, interest rates might pull the other.
You got it. And another really big factor is the U.S. dollar.
How does that work?
Well, gold is priced in dollars globally. So if the dollar gets stronger compared to other currencies, it makes gold more expensive for buyers outside the U.S.
Which could mean less demand.
Potentially, yes. Less demand could lead to lower prices, or at least keep them from rising. Conversely, if the dollar weakens, gold becomes cheaper for international buyers.
And that could boost demand and prices.
That's often the case. So strong dollar, maybe cooler gold. Weaker dollar, potentially hotter gold. It's an inverse relationship, generally speaking.
Okay, got it. Dollar up, gold may be down. Dollar down, gold may be up. It's a bit of a seesaw.
It's a good way to think about it.
All right, let's get practical. Say someone listening is thinking, okay, maybe I want some gold exposure. How do they actually do it without, needing a vault in their basement?
Right, the practicalities. And this is where we at ClearRank usually steer most people towards the simplest and probably safest route for the average investor. Gold ETFs.
ETFs, exchange-traded funds.
Exactly. Think of them like a stock, but instead of owning a piece of a company, the fund owns physical gold bullion. You buy and sell shares of the ETF on the stock market, just like any other share.
So I can buy it through my regular brokerage account.
Yep, super easy. And the big advantage is you get exposure to the gold price without any of the headaches of storing it, insuring it, or figuring out how to sell a physical bar.
Hassle-free sounds good.
It really is. Michelle Sophia, one of our portfolio managers, strongly feels that for most people, these hassle-free ETFs are just the logical choice. Physical gold has issues with liquidity, and you often pay a premium over the spot price.
Okay, so ETFs are the way to go for most. Are there specific ones people look at?
Yeah, there are several popular ones listed in the U.S. There's SPDR Gold Shares. The ticker is GLD. That's kind of the original big one. Then there's iShares Gold Trust, IAU.
Okay, GLD, IAU.
Also SPDR Gold Mini Shares. That's GLDM. It often has a lower expense ratio, which is, the fee for managing the fund. Lower is generally better for you. And Granite Shares Gold Trust, ticker BAR, is another one.
GLDM, BAR, got it. And do they all basically do the same thing, track the gold price?
Pretty much, yeah. They aim to track the price of gold bullion minus their expenses. If you look at their performance over, say, the last 5 years, like up to April 2025,
How did they do?
they've all performed quite similarly. Returns were hovering around the 90% mark for that period.
Right.
GLDM and BR were slightly ahead, maybe due to those lower fees, but they all moved pretty much in sync with gold itself.
Okay, so ETFs seem like the standard recommendation. What about actually buying like gold bars or coins?
Yeah.
The classic image.
It's definitely an option people consider, but as Michelle mentioned, it comes with, well, baggage.
Baggage, like heavy gold baggage.
Yeah, it literally heavy.
Yeah.
But also the costs. You need secure storage, which costs money. You need insurance against theft. There can be tax implications. And it's not very liquid.
Meaning hard to sell quickly if you need the cash.
Exactly. You might have to find a dealer. You might not get the best price, especially if you're in a hurry. And you almost always pay a premium, sometimes a significant one, over the actual market price of gold when you buy physical.
So it's more complicated and potentially more expensive.
Definitely. And we have a pretty direct take on this. If you're not a die-hard doomsday prepper, holding physical gold bars is probably not worth the risk and hassle.
Okay, message received. Avoid the home vault unless you're expecting zombies. What about gold futures? That sounds intense.
It can be. Gold futures are contracts to buy or sell gold at a set price on a future date. They're mostly used by traders for speculation on short-term price moves.
Speculation. Sounds risky.
It is, very much so. They're highly liquid, trade almost 2047, but they involve leverage, meaning small price moves can lead to big gains or big losses. We strongly, strongly caution anyone without significant trading experience to stay away.
Okay, so futures are for the pros, or at least the very experienced, not for beginners.
Absolutely not. Now, another route people look at is investing in gold mining stocks.
So buying shares in the companies that dig the gold up.
Exactly. Companies like, say, Newmont Corporation, ticker NEM, or Barrick Gold, ticker GOLD. The idea is if gold prices go up, these companies should become more profitable, and their stock price could go up even more than gold itself. Plus, some pay dividends.
Potential for bigger gains then.
Potential, yes, but also potential for bigger headaches.
Ah, there's that but again.
Always. Mining companies face all sorts of risks that have nothing to do with the gold price. Labor disputes, new regulations, environmental issues, problems at a specific mine.
Things that can hurt the company even if gold is doing great.
Precisely. So the stock price might not follow the gold price at all sometimes. It adds a whole extra layer of company-specific risk. As we noted, this option is not for the faint-hearted investors and does stray from traditional gold holdings.
So more volatility, more things to worry about.
Definitely. And related to that are gold mining ETFs.
Okay, so ETFs that hold a bunch of mining stocks.
You got it. Like the VanEck Gold Miners ETF, GDX, or the Junior Gold Miners ETF, GDXJ. The good thing here is diversification. You're not betting on just one company.
Spreads the risk a bit.
It does. But these mining ETFs can still underperform physical gold, especially if the whole mining sector is a rough patch.
How so?
Well, look at the 5-year return for GDX compared to the gold ETFs like GLD or IAU. The mining ETF return was lower. They're exposed to things like rising energy costs for the mines, currency fluctuations in the countries where they operate, factors beyond just the gold price.
So even diversified mining exposure isn't a pure play on gold.
Not at all. It's related, but different, more complex.
Okay, so summing up the options. ETFs look like the winner for most people. Simple, direct exposure. Physical is complicated. Futures are for experts. Mining stocks and mining ETFs add extra layers of risk.
That's a really good summary. Which brings us to, well, what's the CleaRank strategic view? How do we suggest people think about this?
Yeah, what's the practical advice?
Michelle Sophia generally advises allocating about 5 to 10% of a portfolio to one of those broad gold ETFs, like IAU or GLDM, and then, importantly, rebalance it maybe once a year.
Rebalance meaning if gold goes way up, sell a bit. If it goes down, maybe buy a bit to get back to that 5–10% target.
Exactly. The idea isn't to time the market perfectly. It's more about, as she puts it, sleeping well when others panic. Having that bit of financial armor.
Financial armor. I like that analogy.
It fits, doesn't it?
Yeah.
Now, for traders, people with a very high risk tolerance, maybe micro gold futures could be a tool for short-term plays. But again, leverage is a double-edged sword. Extreme caution needed.
So for 99% of people, stick to the ETFs in that 5–10% range.
That's the core recommendation for long-term investors. Because let's be honest, gold probably won't make you rich overnight.
Right. It's not a get-rich-quick scheme.
No. But think about recent history. Banks can fail. Remember SVB? Currencies can inflate dramatically. Look at Argentina. Stocks can crash 2008, 2020, 2022. In that kind of world, gold is arguably the closest thing to financial armor.
Provides a bit of stability when other things are shaky.
And Jacob actually had another great line on this. Gold is the only asset that's nobody's liability.
Nobody's liability, meaning it doesn't depend on someone else's promise to pay.
Exactly. Unlike a bond or even cash in a bank, its value isn't dependent on an institution fulfilling an obligation. In a global economy that's, frankly, swimming in debt, he argues that independence is priceless.
That's a powerful point. Okay, so let's boil this down. Key takeaways for someone listening.
Okay, 1. If you're investing for the long term, say 5 years or more, consider a gold ETF like iShares Gold Trust, IAU, or SPDR Gold Minishares, GLDM, for that 5–10% allocation. It's simple, low cost, and gives you direct exposure.
Got it. Long-term ETFs, 5–10%.
If you're tempted by a short-term bullish run on gold and you have a high risk tolerance, maybe consider a tiny allocation, like under 3%, to futures or mining ETFs.
Okay.
But really understand the risks first.
Tiny allocation, high risk, short-term only.
3. Physical gold. Probably best left for, well, extreme scenarios like a total financial system breakdown. Not practical for most investment strategies.
Right, unless you're building a bunker.
Pretty much. And finally, remember Jacob's advice. Don't chase headlines or hype. Evaluate gold on a longer horizon, maybe yearly. It's about risk reduction and preserving purchasing power. He also noted that, based on many forecasts, buying gold ETFs and holding for the next, say, 6–8 months looks like a sound technical approach right now.
Solid advice. Focus on the long game, not the daily noise. We also had a few quick questions people often ask. Let's run through those. Portfolio allocation.
You recovered that 5–10% in ETFs for long-term diversification, under 3% for any short-term, high-risk plays like futures.
Okay. Safety. ETFs versus physical gold.
For most people, ETFs are safer. No storage worries, no theft risk, much easier to buy and sell, less hassle, lower overall risk profile.
Impact of rising inflation.
Gold often does well in high inflation, historically.
Yeah.
But it's not guaranteed, and it depends on what real interest rates are doing, that's interest rates minus inflation.
Can you lose money in gold?
Oh, absolutely. Gold prices go down too. And mining stocks have those extra company risks. Stick to low-cost, broad ETFs if stability is your main goal.
Why do mining ETFs sometimes lag?
Operational costs, regulations, energy prices, currency swings, lots of factors affect the mining business that don't directly hit the metal itself.
Makes sense. And finally, the big one these days, gold versus crypto. Is gold still relevant?
We think so, yes. They serve very different roles. Gold has millennia of history as a store of value and a hedge. Crypto is much newer, far more volatile, and arguably more of a speculative bet on future technology or adoption.
So different tools for different jobs.
Exactly. Jacob nailed it. Gold is a hedge. Crypto is a bet. They aren't really substitutes.
Okay, that clarifies things nicely. So wrapping up, the main message seems to be gold can be a sensible part of a diversified portfolio, primarily as a hedge against economic bumps and uncertainty.
Yep, that's the core idea.
And for most investors listening, gold ETFs are probably the easiest, safest, and most practical way to get that exposure. Think of it less as a way to strike it rich, more as adding that layer of financial armor.
Could have said it better myself. It's about building resilience.
All right, well, that brings us towards the end of this deep dive into investing in gold the safe way. Thanks for walking us through that.
My pleasure. Always good to talk through these things.
And thank you for joining us on the Clean Slate Podcast, brought to you by CleaRank.com. Before you go, here's something to think about. What kind of financial weather, storms, sunshine, uncertainty do you want your portfolio to be equipped to handle? Understanding gold's role is definitely a key step in building that kind of all-weather resilience.
Absolutely.
For more information and resources on investing, do check out clearrank.com. Thanks for listening.